afternoon, and good evening to everybody out there. We're back here with another episode of Between Bears and Bulls. My name is Angel Vasquez, and here today we have, as always, our financial expert, Yinka Majekodunmi. And of course, we're joined once more by the pinnacle of academic excellence. She has been one of our deans. She is our professor. She is, as I can say, and as many students can attest to, one of the best professors here at the university. We have Dr. Miya Burt-Stewart in the studio.
Thank you, Angel.
How's everybody doing today?
All is well. Excited about today's podcast. I'm excited about all of them, but this one, I'm really excited about. So,
Glad to hear it. Yinka, how are you today?
Pretty good. Very good. Excited about today's topic. It's been a good few studio episodes, so we're ready.
Yes.
Okay. Glad to hear it. Today, ladies and gentlemen, we'll be discussing about market cycles. We'll be discussing bull cycles, bear cycles, how to identify them, different marketing strategies, or not marketing, but different investment strategies within these different cycles. And we're going to also discuss the importance of these cycles for investors. So, Yinka, if I may start with you, what is a bull market and what is a bear market?
So, thanks for asking that. That was a very good question. The bull market is the most favorable one, the most popular one that we know about. And bull market generally indicates that the major indices are experiencing appreciation in stock prices. Typically, that needs to be 20% to be considered a bull market. 20% appreciation across those indices, NASDAQ, S&P 500, and so on and so forth. Because price generally goes up and down. So you need to have a reasonable point where you can say this is a bull market. You just can't wake up tomorrow and say, price went up by $2 and now we're in a bull market, right?
Yes.
So generally you wait for a sustained appreciation of 20%, about 20% to call it a bull market. And in a bear market is the complete opposite.
Yeah.
Is a sustained depreciation of the values across those indices. And also general rule is about 20% depreciation because you can't wake up tomorrow because your price went down by $2. Now we're in a bear market, right? It has to be a sustained period of reduction in prices. The good news that I always share when people ask me about bull and bear market, I always have to say this. In the history of the last 90 years or 100 years,
yes,
the United States has experienced a bull market almost 80% of the time. So in the last 91 years, we've had more bull markets than bear markets.
Yeah.
Bear markets just scare the crap out of everybody, so it leads to panic. But typically, bear markets run very short. Why?
Okay.
Why is that? Because there's people who's their responsibility to make sure we don't have long periods of bear market, right? And so they do what they have to do to make sure the economy is back rolling.
Okay. And let me ask you, why is this important for investors? Why is it important for investors to know the difference between a bull and a bear market and when we're in a bull market or when we're in a bear market?
It's very important because investors need to know what market they're in to be able to take the best action investing, right? You have to know what's the cycle, where you are in the phases to make the best decision for yourself. So you don't want to be the person that's making the wrong decision in the wrong market. But generally speaking, we know the market in itself is just an indication of sentiment. Some skeptics always say the market is not real. That's because of the price of a share doesn't really mean the company is great sometimes. It's just the experience that people have or the sentiment that people have at that time. So very important.
And if I can kind of piggyback off of what Yinka is saying, in terms of knowing the difference between the bear and the bull, because you need to know what moves to make, right, in what market. That, I guess I want to say that's certainly important, right? You don't want to buy, pay $30 a share for a stock that is constantly on the decline. And we can look at whether it's the 52-week, whether it's a 3-week, whether it's a 6-month, right? We can look at the performance of the stock. Now, I'm also reminded, though, of, say, the economic downturn of 2008. I'm reminded of I could just kick myself, but I'm reminded of when Ford stock I think got just at $1 or below $1, right? I'm reminded of AIG stock. So it's like certainly we were in the bear market. That's a given, and everyone was like, well, these aren't the stocks to buy, right? Nope, they're falling. They're not going to come back. Well, who came back? Those really were the stock to buy at the time.
Exactly.
Now, unless you are an investor or unless you are an astute person that follows the market, right, you would not have known how to flow, during a time like that. So while we say it's important to know the difference between the markets and know where we are in terms of a cycle, it absolutely is important, particularly for the novice investor. Those that are maybe a bit more advanced, right, will know that now is the time to strike, take advantage of, purchasing certain stock. So it's really one of those. If you know, right? And then if you don't know, certainly you should be getting educated before jumping into the market. If I can, I pulled up I'm getting ahead of myself because we're talking about a bull market. So Yinka took the words out of my mouth, certainly when you talk about what a bull market is. And while I am an Aries, right, that's the ram, right, first sign of the zodiac, the bull ain't too far, right?
The next two of us.
The bull is not too far. So
that's a good one.
Who else is an Aries?
Me.
Okay, yeah. So Angel knows. So you know why your professor is so pushy now, right? But again, that's those that know, right? And so when you talk about knowing when to invest and knowing, right, when is a good time to strike, and you don't want to make moves in the wrong market. Again, some of us, when you talk about making the wrong moves, to some it's a wrong move, and then to some of us that know, right, we know it's really the right move,
right.
But you still have to be in the know to know that.
And if I may, because so now we've just discussed, right, what's a bull market, what's a bear market, right? You gave us the technical definition. It has a 20% increase or a 20% decrease over a sustained period of time. But now, how do we understand these markets? How do you understand a bull market and a bear market? Because it's to my understanding that, well, while in a bull market you can make money because things are valuating in price, right? In a bear market, you can also make money when things are going down in value.
Well, I don't know that you necessarily make the money in a bear market. You're certainly position yourself, right? Because if Ford stock is $1, right, and it's during the bear market, right, money is not necessarily being made there. It's like you're buying and holding. However, as the market bounces back, then, as we are gearing back towards a bull market, that's where the money is made. So and Yinka may be able to, give some other examples of where you actually do make money in a bear market. But for me, right, just in my understanding, and Yinka can share, you don't necessarily make the money in a bear market. You're certainly position yourself, right, to make the money by purchasing, stock that, you've got spectators saying that it's done, they're dropping, people think that the company's never going to bounce back. They're going to, dissolve or go away.
Right.
Whereas, again, AIG and Ford and Chrysler and those kinds of companies, the U.S. economy was so tied to these kinds of companies, right?
Exactly.
And from an employment standpoint, from a revenue standpoint, right? From a market standpoint, from a community standpoint, that there was just no way that these kind of companies could be allowed to go away. And so, again, those who know that, all right, you better jump on these stock now because when the market comes back, they'll be one of those numbers. But
that's a good point. I like using metaphors because I'm a simple guy, right? Right? I'm a simple guy, so I like using metaphors. When you're talking about bull and bear market, that's like talking about Earth and our hot and cold weather. To really get a good, broad knowledge of what's happening, you have to zoom out of Earth a little bit more. And then what do you see? You see the sun. And so the planetary system's like, oh, because when it rotates this way, that's when it gets cold because it's this distance from the sun and the seasons, and this is how things are actually working. But while you're on Earth, you're like, it's hot and it's cold. As you zoom out, you get the sense of what's happening and what's causing those seasonal changes. That's exactly what happens in the bull and bear market. You really have a full phase, 4 main stages, right? That you have to actually account for, because within those 4 phases is where the bull and bear market comes in. But the first phase, I think that's the cycle, because it starts over, is the accumulation phase, right? You have the accumulation phase, you have the markup phase, you have the distribution, and then you have the markdown. Yes. And in that is where the bull and bear market happens, right?
Okay.
So my favorite one to always talk to people about is the accumulation phase, because 9 out of 10 times, most casual investors, retail people, regular people, they react during the markup or markdown phase. They're really not very well versed during the accumulation distribution phase. So accumulation happens when institutional investors are buying shares very silently. And when I say silently, I mean silently from the data perspective. They're buying shares, and it's very strategic. They buy shares just enough not to increase the volume so much to increase the price. They wait for it to settle down. They buy a little bit more, so they accumulate. That's what I call accumulation phase, because they're buying it. So regular people like me and you are not aware of this happening unless you have the analytics to be able to follow these trends. But that's what's happening. By the time they get to the markup phase, that's when it's spiked in price. And that's when me and you find out, or the regular people find out, and like, oh, this stock is getting better. This makes money. And you start buying, right? And when you stop buying, that means the demand is now getting higher than the supply. So you it starts ramping up. That is the markup. So prices start going up. Guess what? The institutional investors in the original phase, the first phase, which is accumulation, they're just sitting down. They're looking. They're very happy. They're rubbing their hands like, wow, this is great. Meanwhile, people like us are buying.
Yeah.
Guess what comes after the markup phase? The distribution.
Okay.
Because now you've ramped up price so high. So during the markup is what we start calling, oh, we're now in the bull market, right? That's the markup, because you see the market going up. But there's something happened before that, is the accumulation. Again, after that, the distribution phase, which is when the institutional folks that bought start selling a little bit, selling a little bit. As they sell, right, there's more shares available in the market. There's probably going to be more demand, right? And demand starts dwindling over time. And then what do you see? It's sustained markdown. So during the distribution phase, the institutional investors are selling shares. That's what you start saying, okay, now we get into the markdown, where you say, oh, it's a bear market, and price starts dropping because there's so much now, because the people who bought in the accumulation phase are selling, and they're flooding the market. The prices are dropping, and then we say it's a bear market. So just zoom out a little bit. Now you see the sun and you see the planetary system, like, wow, this is what's actually happening in the background to cause these changes. And so my favorite is the accumulation, just to identify the accumulation, and the distribution phase, because most of us literally react to the markup or markdown phase, and that's what we call our bull and bear market typically, because we're not paying attention to the overall market.
Wow, excellent, Yinka. Yeah, I like that. But I like the analogy too, where you're saying, yep, just kind of earth and just step out, and you get to see what's happening behind to cause and create this. Yeah, that's interesting.
I love metaphors, man. I'm sorry. I should have been a poet.
No, of course. But, I do have to ask, because it's to my understanding, so at least to what I've understood, to what I've kind of overheard and learned about, in a bear market, you can short stocks, or you can have a lot of put options against stocks, and you can, in that kind of respect, you can make some money against a stock, could you not?
Absolutely. But you could short a stock in any phase, really. You don't have to wait to a bear market to short. But by the way, I would go as far as saying in the bear market, most people may not fall for your shorting, because the market is not good. So you have a better chance of shorting a stock when the market is good during the bull market, because people's confidence are inflated.
Yes, I agree.
Then you put in your contract to short the stock, and buy, people are like, the price is never going to get that low. Sign me up. Right? Sign me up. And then boom, you surprise them. So
whereas during the bear market, confidence is already low, and we're already scared, running scared, and it's like, we don't need anything else to add on to make it seem or present the appearance of a weak market or not being able to make money.
Exactly.
So then I have to ask, because with that said, that you can short a stock in not necessarily just in a bear market, but also in a bull market, what are I'm not gonna say attractive, but what would be some more financially intelligent ways to invest in these different cycles?
Some more intelligence. So repeat the question.
So I phrased it kind of strangely, but the question more or less is, what would be some different ways to strategically invest in these different markets? Because when it's a bear market, you obviously kind of want to hedge your losses. You don't want to have so much exposure that your portfolio loses a good chunk of it. But when it's a bull market, I imagine the idea as always is expand your portfolio and increase your net worth.
So you're just saying, when in either market, whether it's a bear or bull, what are some of the ways to continue to expand your portfolio?
More or less,
More or
to
less.
continue expanding, but to also kind of keep it safe. Because last episode we discussed diversification to mitigate the risk, the exposure that you have. But and now here between bull and bear markets, right? Because it's two different scenarios.
Yeah,
Right?
yeah.
One, you might have more opportunity to make more money. The others, you kind of want to protect against losing that money.
So you said something that you used the word safe.
Yes.
And I don't know that's I don't know about safe, right? Because when you talk about markets, safe, when I think about the word safe, I think about the type of investor then, right? Whether it's an aggressive versus, just a moderate or, a light, someone that doesn't have much money tied up in the market, as opposed to somebody who's very aggressive and, 9/10 of their money is tied up in the market. So when you talk about, safe ways to invest in either market, I guess that's relative, right? That's subjective or relative. But I think we just talked about it, right? When in a bear market, again, in terms of making money, for me, I see how I can be positioned to make money, right? It's a falling market, right? It's a down it's a down, economy, right? Whether it's local or national or global. And so, ain't really no real opportunities to make money for me based on what I see. But again, if it's certainly a time to start tapping into, those markets or those companies where the shares, have really plunged. But those are very integral industries, right? Again, whether it's automobile, whether it's insurance, even banking, right? So it's just a matter of knowing what to buy in a bear market. And then in a bull market, it's not a matter of knowing what to buy. The market is very evident in terms of if you look at CNBC, if you look at Squawk Box, if you look at Kramer, right? We always know what's going on. I read the Wall Street Journal, and supposedly Warren Buffett has, recommended these particular stocks and so on and so forth. So during a bull market, we always know what's hot. It's just a matter of, do you have enough money, right, to make those purchases? So being able to understand, I think you talked about this, being and staying diversified, right? So pharmaceutical, IT, banking, oil, marijuana, so on and so forth. So I think that in terms of making money during a bear market, right, you can always be positioned, right? And during a bull market, you can make money. In terms of safe, again, that's the economy, right? So one false move, COVID-19, right? It was just one day at the end of 2019, the word came down about a virus in China, and the next thing you know, there's a pandemic, right? It wasn't on the horizon. Nobody knew anything about it. It was not like it was like the housing crisis where, there was some trickle and word of this coming about, right? Some of the shenanigans that were being, pulled in the banks and countrywide, and so there was what's his name? I can't think of his name right now, but we had, economists that talked about, right? They would prophesy and they would talk about what's to come and what's going to happen if we don't, right, correct the market, or if people continue to behave in certain ways as it relates to spending. And so that did happen, right? But, from a safety standpoint, I don't know that you could ever really be safe because whether it's volatile in the way of Bitcoin or whether it's volatile in just a generic way, right? And volatile in a way of a Disney, right? Fighting with the local government or, so it's I think it's certainly subjective when you talk about safety. It's subjective when you talk about being able to make money, right, in a bear or a bull market. It depends on the investor. It depends on the market. It depends on spectators. It depends on what folks say about, are saying about, different industries or different companies. Tesla. Classic example today, right? So just 3-4 days ago, Tesla was talk of the town because they were talking about laying off, I think, 10, 20, 30%, something like that of their workforce, right? And so now I'm looking at the headline earlier today, and so has Tesla reversed they're saying Tesla now has flipped the script, and so they're only talking about 6,000 employees. And now they're talking about a new vehicle that they're going to be rolling out, being able to take up, some of the slack that, from them, from a forecasting standpoint, right? They felt that they wouldn't be able to meet expectation because of the issue with the Cybertruck and then the Model 3 and the Model Y. But now there's a new vehicle that they're planning to put out, and this vehicle will, make up some of the numbers of cost. Yeah. So again, when you talk about safe, right? It was, it's one thing today, and could be a whole nother.
And it's really always going to be market sentiment, right?
Yeah.
Because that's a good point she's making.
Sentiment. Yeah.
Because I remember when Netflix first raised their prices about 7 years ago, maybe, everybody went crazy. And the stock price dropped drastically. And I looked at the stock price, and it dropped, and everybody was going ridiculously crazy. The market was criticizing them. And I went to look at their users and their cash balance. And I saw how much they had in cash. And I said, I'm going to buy a whole bunch. Everybody else was selling. And I'm like, no, I'm going to load up on Netflix stocks. That's what I'm going to do. And if anybody that I told understood how much I bought then, they'd probably think I was crazy. Like, come on, man. Like, they're going to run out of business because nobody's going to buy subscriptions anymore because of a $2 increase in price. And I just didn't believe the market was going to be that way for a prolonged period of time. I thought it was just a very temporary sentiment. So yeah, market sentiments do happen. And so you have to balance your strategy accordingly. You can't react. If you're lucky enough to know fundamentals, you're good. Right? Yeah. When there's a bull market, you read the fundamentals, you know what's real and what's not, because there's a lot of things that are not real. And then you have extraordinary examples like in a COVID pandemic that you can't plan for. There's no analytics that you could have used to get ready for COVID. Matter of fact, most people don't know, up until COVID 2020, typically a bull market lasts about 4 years. 4 years.
Okay.
Up until COVID, do you know how many years of bull market we had?
I want to say maybe 15-ish years, a little more.
11 years,
11,
which is the longest run of a bull market that we've ever had.
Okay.
From 2009 to 2020.
Yeah.
Okay.
We had we were on a bull run until COVID. Nobody could predict that, right? So these things are a little bit more complex. But what you seriously want to do, bull market, look at your asset allocation. We talked about that last week.
Yes.
Get more discipline about how you allocate the assets, your distribution, what you're investing in, spread it across a little bit more. And then perhaps it's a good time to look at growth stocks. And growth stocks are companies who are projected to increase in revenue and sales, right? And thus you grow with them, right? So there's different things to look at during a bull market. But again, bull market typically happens more frequently than bear. Obviously, in bear market, most people do a sell-off. But what do most institutional investors do? They wait till it gets to the bottom and they buy. So most people say, oh, don't buy, it's a bear market. But most people will wait and start buying during the bear market because they know I'm going to use this word carefully, it's an artificial reaction by the market participant. That's what people, institutions normally look at and say, okay, it's an artificial, and they are investing for long term. Now, if you're investing for short term and you're a day trader, perhaps you're going to be selling because you don't want to, have any losses. But a long-term play, you're going to want to buy because you know the reaction is artificial. So that's...
And, you know, I have to ask because, you know, you mentioned looking at the fundamentals. You mentioned looking at their cash, which I would imagine implies looking at their cash flow, looking at their actual financial statements and the whatnot. And on top of that, too, Dr. Burt, I believe you also mentioned there's no really sense of safety when it comes to investing.
Yeah.
So, you know, human nature would have it that people will invest recklessly, they'll invest emotionally.
Mm-hmm.
So how do you try to balance out between investing emotionally, or instead of investing emotionally, investing logically and actually looking towards indicators and looking towards the bigger picture of what's really happening?
So the emotional part of that, so the emotional investing is me taking my money and keeping it under my mattress, right? That's the emotional piece, right?
Yes.
Making sure that I don't lose a dime. However, and Yinka just, you know, talked about it, when you talk about investing in the smart way, you know, again, that's kind of the market sentiment, right?
Mm-hmm.
It's definitely a part of, I've said this, when you know, right?
Yes.
You know, a day trader investing versus an institutional investor, you know, versus just a single, right, investor, or just a common, you know, lay person in investing, and just trying to be as educated and savvy as possible, right, when making moves, right? Make sure that if you're not reading, that you spend time with someone that you trust, right? Someone that not just giving you information because they're trying to get you, you know, they are a broker or they're attached to a broker. And so it's really just about getting you in, getting you to buy. But, you know, speaking to and spending time with someone that you trust that can help you to understand, right, how to move, right, how to make moves. Looking at, you know, just, and it takes some onus of ownership from us in terms of, you know, being responsible for the knowledge, right? Who are the better companies, or who are the growth companies, not better, but who are the growth companies, right? Who are the stagnant companies, right? Who are the, you know, the on the rise, right? Who's getting ready for an IPO, right? Who's, you know, recently done an IPO, you know, where are the big boys and, you know, what are the 52 highs? So just really getting educated and understanding, doing enough research to understand, right, what's happening in the market, what's happening with companies, right? And how understanding how you want to flow, meaning the kind of person you are. Are you an aggressive investor, right? How old are you, for one, right? And how much can you stand to lose? How much can you afford to lose, right? I've been transparent, right? So I'm 54, and I'll still lose the bank. I'll take every dime. We playing Texas Hold'em. I'm putting everything in the pot, right? The foolish, right? Foolish. I have no kids. I've got nothing to. I've got really no one to. I don't have any kids, right, that I've got to look at. I don't have a family that I've got to be responsible to. So I shouldn't make foolish decisions, but you know,
you can take more risk,
right. But I'm that chick, right? Yeah. You've got to know who you are, right? So again, Texas Hold'em, I'm putting everything in the pot, whereas not everyone can do that, and so you've got to know, you've got to make sure that you understand who you are and what you can do as it relates to risk, right? As it relates to savings, as it relates to, you know, your future. You've got to know who you are and what you can do and what your tolerance is as it relates to investing.
Okay, and I like that you put it like that, because it's, Yinka, you have mentioned this in previous episodes before. There's a matter of risk appetite, and then there's also a matter of risk tolerance, right? When you're young, you might have a large risk appetite, but you don't exactly, or you might not exactly have the tolerance for that much risk.
Absolutely.
Your ability and your willingness to take risk are completely two different things.
Yes.
Every time. You might be very, very willing to take the risk, but you may not have the ability to take the risk.
Yes.
And people normally mix those two. So young people, they're willing sometimes, but perhaps they don't have the ability.
Yeah.
So I think Dr. Burt made a good point. You have to assess your risk. And that goes for all markets, really, because every decision you make is going to result in a financial outcome. Whether or not you use fundamentals, whether you use indices, again, my general rule has always been that there should just be a few people who are disinvolved in the market, right? I think most people should use automation or professionals. But if you're blessed and lucky enough to be able to follow the market closely, read fundamentals, use fundamentals, perhaps you'll be able to make some very, very good wins. But it takes a lot of effort, because for example, in the accumulation phase, most people don't even know it's happening because they're not looking at the charts.
Yeah.
Right? By the time you find out it's happening, you're already in the markup phase and you're paying a higher price. So think of something that's simple, right? I haven't looked at the chart of most companies right now. I've been here all day, working in the afternoon. Someone comes to me and says, can I buy this share? Like, how am I going to make the decision? What would I say to that person?
Yes.
I'll be doing I'll be like the other person, I'll be making an emotional decision. Oh, I think the CEO is a nice guy. He's very smart. You should buy it. I did not look at fundamentals. I did not look at any charts. So perhaps maybe if I looked at charts and I had the time as a casual investor to look at the charts, I may say, wow, this is an accumulation phase because I see the institutional investors buying and waiting and making this very, very, is actually designed to be not obvious that this is happening. Is specifically designed. They're playing within the support threshold, right? To make sure people don't see the spike in volume or the spike in price over a period of time. And by the time you know it, you're in the market phase. So
I think about, so I like what Yinka is saying. I think about it's probably been about 20 years. And I don't know how I really got to business. I think that from the time I was 15 years old, I thought that there was no reason for me to live other than to go to law school and to be a lawyer. From 15 years old, I was like, the only reason I'm on earth is because I'm going to be a lawyer. And I mean, there's just no reason for me to live, no reason to breathe. It was always law. And then I remember at one point, and everyone has heard of, Kanye West, his mom, Donda. His mother was a professor at Chicago State. I'm born and raised out of Chicago. And I remember, though, in addition to wanting to be a lawyer, English, right? Even today, I love English. I have no English degrees, right? But I love English, rhetoric and composition. And I remember being on the phone with Donda West by way of a good friend of mine who was her cousin, Kim Wallace. I remember Kim connecting me to Donda, and we were having a conversation about me getting a master's degree in English. And that's her background, her field, right? English, writing English. And I remember her, talking to me. So at the time, how today we make degrees, right? We create degrees, right? And that kind of thing. So at the time, though, that wasn't a hot thing to do, right? The creating degrees based on market need or desires, right? And so there was no master's degree. No one anywhere offered a master's degree in composition and rhetoric, right? So I couldn't get I didn't want just writing, right? I wanted a master's degree in composition and rhetoric, right? Rhetoric and composition. And so got off the phone with Donda, and that kind of bursted my bubble. I was like, so I got to be a lawyer. I ain't going to be a writing lawyer, but I'll work it out. But I remember thinking I still wanted to go to law school, but now maybe instead of doing something in the space of writing or English, I can do business. Just one day, one day. English had become a distant dream, and so I, picked up something else, right? And so I said that to talk about just where the desire for business came from. And I remember, this is probably over 20 years ago, I remember one of the first things I did was got a subscription to the Wall Street Journal.
Wow.
I didn't know exactly what I was looking at, but this goes to what Yinka is saying, just the common person, the lay person, right? I didn't fully understand what I was looking at, but I was a smart enough, chick.
Yes.
I've been in the military, disciplined chick, with knowledge, world travels. But I remember getting a subscription, having it, and I was so proud to have it delivered to my home, right? Every day I would get the Wall Street Journal. So I was all that in a bag of chips now, because I was getting the Wall Street Journal at the crib, But I remember I would always go and I pay attention, and I learned that the business section, the stocks. I remember, looking at I was like, okay, so Dow is 20,000, or the Dow is 15,000.
Mm-hmm.
So is this like the percent that is up, or is this like, I just remember just digging at it
Into it.
and just right. And fast forward even to today. So when you talk about people learning, or just taking some time to get knowledgeable in some way, something as simple as getting the Wall Street Journal, right? A subscription, or whether it's Bloomberg, or just getting a subscription to something, and take your time. I took my time, right? I took my time in terms of learning it. It would be, they delivered the paper every day. They would be stacked up, and I'm consulting, starting out my own little business, and so law school didn't work out, right? Because they wouldn't let me work, and I had to eat.
Yes.
So I would take my little Wall Street Journals and get in a car and go to my office, right? So but I took my time in terms of learning, learning, right? And I, prideful chick, type A, alpha female, overachiever, I couldn't go to the men or and let them and have them explain it, because then I feel dumb, right? I feel like I'm not a so in a way I was a glutton. I was trying to avoid shame, right? Being shamed by not asking someone to explain it to me. But I liked the journey. It was my journey, and I liked the way that I got to it, because I got to understand it in my own way and in my own time.
Dedicated yourself to it.
And I dedicated
which is
myself
rare,
to it.
by the way.
Yeah.
It's rare.
Yeah.
Most people don't do that work, and that's the difference, right?
Yeah.
What she did is dedicate herself to understanding and putting the work in. Most people think they trade in, but they're really reacting to market sentiment. It's very different. Very different.
Yeah.
And I like that you mention it, because because it shows a how to say, a great discipline. One word I guess I could put in is a Herculean level of discipline and internal strength to dedicate yourself to learning, to analyzing, to breaking it down until you understood it.
Yeah,
and
that's that RAM, that Aries, that RAM, that type A, that overachieving, that alpha female. That's all of that.
I like that you put it like that, because it's, it stands as a testament to, if you can do it, who's to say that other people can't achieve it?
Absolutely. And that's why I did it, because I know that women before me, right? Black women, white women, Hispanic women, Asian women, I know that women, right, before me, right? Wall Street is still a male-dominated world, right? In corporate America, it's still a male-dominated world. And so I know that women had done it before me, right? I would watch, Carly Fiorina back then, right? Ursula Burns back then, before she became, the CEO, Ken Chenault. So I saw the rise of folk that looked like me in business. So I knew that they had to have done it, in order to be in the positions that they were in.
And I really like that, and I appreciate that you give us that background to yourself, because it serves as apart from it being a good testament for our listeners, I believe it also serves as a how do I say, as a sense of inspiration, per se, as a sense of motivation.
Hopefully.
Because when you're young and you sometimes you don't want to ask other people for help. You kind of want to figure it out on yourself. But the moment you don't figure it out, you easily get disappointed. And if you overthink it, you overthink it, and then it ends up being in the back of your head until you just drop it. So I appreciate that you tell us that. And to start wrapping it up here, because I know we all have to go out. So
and see what the markets are doing.
We gotta see
market is closed already.
Well, we can look what's happening around the world.
The only market that's open right now is the crypto market, I think. So
it's open 24/7.
Right, crypto market is open 24/7.
Exactly. So if there are any recaps that you could both give us before we close out today's episode.
I mean, the recap is always going to go back to being, strategic, not reacting, and not feeling as if you have to be an active daily participant in the market. I think you could take your time and learn the basics and come up gradually, but it doesn't stop you from investing. You could put $50 a month or $100 a month into a well-distributed fund, ETF, or whatever you have access to, and invest so you don't slow yourself down. But the market, clearly, look at this conversation today. This tells you how complicated the market is.
Yeah.
It's not simple.
Yeah.
I know people say that's simple because we have tools and you could go on this app and just buy and sell and buy and sell. One day we're going to talk about tax implications of buying and selling.
Yes.
Because that's a completely different, animal to deal with.
Yeah.
Yes.
And people just think it's about buying and selling. I had somebody call me in like February, says, I did my taxes and I have this huge bill. And I said, what happened? What did you do? Oh, because I sold all this stocks. So you sold it? What do you want me to do now? The year's over. You can't do you owe. So even part of that, once you know the market and you understand the investment strategies to use, there's a taxation side to this that we didn't even talk about yet.
Yes.
That needs to be reviewed by somebody who knows how these things impact your tax bill, unless you just want to pay a whole bunch of tax for no reason. So, that's my closeout. My closeout is very complex. You can look at Earth, and that's fine. But at some point, you're going to have to go a little bit further out and look at the universe a little bit to see what's impacting Earth.
Yes.
That's my take.
I like that. And so I echo what Yinka said. And I'll come back because while Yinka shares how complex, right, investing and the market and Wall Street, all that can be, I still want to encourage, right, particularly young people, anyone, but particularly young people, right, that and anyone that's from, say, a disadvantaged community, anyone that's from, disadvantaged background, anyone that didn't, that's just had a tough time in life. I want to encourage, right, anyone that wants to be an investor, right? Again, anyone that wants to be a part of that number, anyone that's trying to get in the game. We talked about this. I think it was certainly one of the past podcasts, and I talked about ways to invest, right? Whether it's, putting $5 a week or $10 a month. Listen, wake up, and while you only own a fourth of a share, you are still an investor, right? You still, have a right to call yourself an investor. So I definitely, and so I tell my story about loving English and I didn't think I should live unless I was in law school. But somehow or another, just that innate, feeling and being of business, right? And from business. And again, I don't 100% know where it comes from. I just remember having the conversation with Donda and the realization that I couldn't get an English degree. And so it was kind of like the next best thing was a business degree. Wow. And it just, took off. Took off from there. But as you talked about, I say that to inspire others. And while the market in this whole, world of stocks and investing is complex, don't be discouraged, right? Don't walk away, right? Don't walk away. If you want to be one of those, if you want to be amongst the numbers, you still can and should.
I agree.
Well, thank you, Dr. Burt. Thank you, Yinka, for all the knowledge you've both imparted today. This has been, it's been an immaculate episode. It's been a very, very good episode. And, to our listeners out there, thank you for tuning into this episode. This has been another episode of Between Bears and Bulls, and we'll see you guys next time.